So today you're going to be learning about investing basics, stocks. Learning about investing is a lot like learning to ride a bike. It may look complicated, but once you learn the basics, you can minimize risk and protect yourself. There will be a lot of good and bad days, but learning the basics will help you minimize risk. So starting with the basics, common investments is stocks. A stock represents partial ownership of a company. When you buy a stock, you are buying a piece or a share of a company. By owning a share, you own a small fraction of the company's assets and have a claim on its future earnings. There are two ways to make money by investing in stocks. The first is through stock appreciation. That is when a stock you own goes up in value. So if you, the investor, buys a stock at one price and the price goes up, the investor could then sell the stock at a higher price to another investor. The second way to make money is through dividends. A dividend is a periodic payment issued by some stocks. Dividends are a way for a company to pay its investors. Here's how stocks work. Let's pretend there is a company called ABC and they make really good skateboards. So good that the company wants to expand to sell skateboards worldwide. To do so, the company needs to raise money, otherwise known as capital. One option is for the company to take out a loan, however, that would put the company in debt. Or it could issue stocks by going public. This would allow the company to raise money without going into debt. So instead, it sells shares of ownership and a claim of its future earnings to investors. A typical investor is someone with some extra cash. They are looking for an investment that has the potential to offer better returns than a savings account, and they are willing to accept the risk of investing in stocks. So the investor thinks that ABC is a good company that is likely to grow. So the investor thinks that buying a share in the company is a good investment. So how much does the share cost? Suppose ABC wants to raise $1 million and decides to issue 1,000 shares of stock. Since each share represents a fraction of the company and there are 1,000 shares, each share represents 1/1000th of ABC's company. Since the company wants to raise $1 million, at the initial public offering or IPO, each share would be valued at $1,000. If the price stays the same at the IPO and our investor decides to buy one share on the open market through his online broker account for $1,000, this is what could happen to the investment. If the company ABC does good and profits increase, the company's value goes up. As a result, the stock price may increase as well from $1,000 to $2,000. If the price goes up, the investor could then sell his share to another investor. However, if ABC Company's ventures doesn't do so good, its value can decrease and so can the stock price from $1,000 to $500. If so, our investor could lose money if he decides to sell at the current price. When it comes to investing in the stock market, the goal is to buy when the prices are low and sell when the prices are high. But stocks in the market don't always go up. They can stay the same, they can go down, or they can change price quickly. This is why stocks are risky. But with this risk comes greater potentials for earnings. You must take precautions to minimize risk by creating an investment plan, investing in a variety of companies, and learning trading strategies. This is just the beginning.